As the summer solstice nears, a sense of anticipation hangs thick in the continental air. On Thursday, the European Central Bank is poised to embark on a long-awaited pivot, one that could reshape the economic landscape across the euro area. After a protracted stretch of fiscal austerity, the monetary mavens in Frankfurt are expected to cut interest rates for the first time since those heady pre-pandemic days of 2019. This overture toward looser money carries profound implications, both economic and philosophical. The ECB's stance over the past year has been one of stern discipline, raising borrowing costs to choke off the inflationary dragon that reared amid pandemic-induced supply shocks and the reverberations of the Ukraine war. Now, with price pressures showing incipient signs of moderating, the pendulum seems primed to swing in the opposition direction. Yet this transition will be no straightforward affair. The path forward is strewn with tough riddles that will test the mettle of ECB President Christine Lagarde and her cohort of rate-setters. For one, there is the fundamental question of degree: how forceful will this loosening campaign be? The simple act of turning the monetary spigot ever so slightly could prove a potent psychological tonic, stirring animal spirits among households and businesses alike. As the sage Holger Schmieding of Berenberg Bank observed, lower rates do matter. News that the ECB has started to cut rates could draw attention and lift sentiment. But after enduring a year of economic stagnation, the euro area may well require more than just a subtle gesture. It could crave an audacious deluge of liquidity to truly resuscitate spending, investment, and growth. Schmieding suggests the anticipation of coming rate cuts has already nudged down mortgage rates from their October peaks, helping stabilize wobbly housing markets in Germany and beyond. A bolder easing campaign could unlock even more pent-up demand. Herein lies the core tension: how deeply to press the monetary gas while still maintaining a semblance of inflation-fighting credibility. The latest EU-wide data offered a sobering reminder that rising wages and a resilient jobs market continue to stoke price pressures. Headline inflation clocked in at 6.1% in May, markedly higher than projected. The fear is that overshooting with stimulus could rekindle very inflationary forces the ECB has labored to extinguish. This leaves Lagarde with a razor-thin tightrope to navigate. Going too far with easing could undermine painstaking efforts to re-anchor inflation expectations. Yet failing to ease enough could condemn the still fragile recovery to an anemic fate. It's a classic case of being darned if you do, and darned if you don't. Lagarde's unenviable task is further complicated by uncertainties over how other major central banks will act. Comments from Federal Reserve officials have cast doubt over whether the American Central Bank will follow ECB's dovish pivot anytime soon. Such policy divergences could weigh on the euro and export competitiveness, a legacy burden for an institution formed to maintain monetary union. So in many ways, Thursday's meeting marks an Rubicon crossing moment for the ECB after years of steadfastly battling inflation's scourge. The bank's stern centurions must now beat an artful retreat from their campaign of monetary tightening without abandoning the field to rampant price pressures. It's a high-stakes balancing act with profound consequences for the livelihoods of over 340 million Europeans. How, then, will Lagarde and company navigate this economic brain-teaser? In the run-up to the meeting, influential voices like the Dutch central bank chief Klaas Knot have hinted at gradual, incremental approach of easing, perhaps 3 to 4 quarter-point cuts scattered across the remainder of 2023. This would preserve optionality to pause and re-evaluate as the year's economic data crystallizes. For her part, Lagarde seems likely to deliver a vintage performance of defensive ambiguity from the ECB's quarterly pulpit. Expect platitudes about data dependence and the need for vigilance as she rebuffs efforts to box her in on the future policy path. The ECB head has been careful to describe the coming easing cycle in the most open-ended terms, speaking of rates merely moving down somewhat this year while staying in restrictive territory above 3%. Such calculated vagueness reflects more than just Lagarde's proclivity for obfuscation and love of flexibility. It hints at a deeper philosophical reconception unfolding within the hallowed halls of the ECB. For this sudden dovish pivot represents something of a paradigm shift, a renunciation of strict monetarist dogma in favor of more nuanced, holistic policymaking. Whereas central banks have traditionally slashed rates primarily as an emergency salve during economic crises or deflation scares, the ECB has now taken the extraordinary step of easing into a garden-variety recovery. It's an admission that sometimes the stimulative punch of lower borrowing costs may be warranted even in the absence of acute duress, a concession to the secular forces of aging demographics and declining productivity that have suppressed economic vigor across the industrialized world for years. To the monetarist diehards, this could smack of inflationary licentiousness, chucking the rule-book of hawkish orthodoxy to chase an ephemeral, unsustainable high of artificially goosed growth. But to more pragmatic skeptics, it signals a healthy evolving of central bank doctrine, embracing the sobering realities that uncomfortably high prices can coexist with sclerotic growth, and that a blunt focus on inflation lancing can be self-defeating absent a holistic view. In this light, the ECB's moves represent not ideological zealotry, but a clear-eyed reckoning that the textbook rules require rewriting. So as the economic spotlight shines on Frankfurt this week, more than just HR by HR monetary mechanics will be on display. At stake is the future intellectual boundaries for central banking doctrine, and whether the rigid inflation mania that has dominated for decades can evolve into a more multidimensional, environmentally conscious framework. Watching Lagarde and the Governing Council deftly navigate these dicey philosophical crosscurrents may well prove as compelling as the granular policy specifics themselves. For in many ways, this gathering exemplifies the beautiful contradictions of our globalized human world. Imbued with the weighty responsibility of shepherding a recovering economic bloc, the central bankers must reconcile opposing objectives, harmonize fragmented views, and abandon dogmatic purity for reasoned pragmatism. It's a delicate choreography of competing priorities and inconsistent demands, one where missteps could deal painful economic blows but bold leadership could unlock a collective flourishing. At its core, this high-stakes rates riddle encapsulates the essence of our mortal existence. We all face volatile crosscurrents, buffeted by unforeseen shocks and inescapable trade-offs. Figuring out when to lean in and when to apply the brakes, when to floor it and when to pump the brakes, this is the never-ending dance we all must master if we're to pilot our singular journey with any semblance of grace. So as we watch Lagarde and her cohorts grapple with the latest monetary puzzle this week, it's more than just finance and inflation dynamics at play. It's an ultra-high-definition mirror into the grand existential drama of human striving to harmonize dissonant forces into something coherent and beautiful, against the timeless cosmic vibration. The choreography may not always achieve Tchaikovsky perfection, but the attempt to bring holistic order to perplexing disarray, this soulful effort is among the highest artistic expressions of which our philosophizing species is capable. And in taking up that daunting creative mantle, the shapers of monetary policy join poets, composers, physicists, and philosophers in plumbing the richest depths of what it means to be alive.